welcome Anders. Nice to have you here today. We have several questions, and starting, I guess, with what we're all awaiting, which will be Trump's discussion this evening. What do you see he will say, and what are the scenarios that you're looking at around that difficult question?
It is a really difficult question, and it's fairly unlikely that my conclusions will hold over the night, because this is very uncertain territory. Over the last few days, the situation has actually turned a bit more problematic. The US administration is floating ideas of a global universal tariff of 20%. We've also heard Bessent talk about the Dirty 15, fairly high tariffs on the 15 most important trading partners for the US, and we previously heard 25% on Canada, Mexico, semiconductors, automotive, steel, and pharma. So the outcome space tonight is fairly broad. We could be in a situation where we see tariffs increase 4 or 5 percentage points, adding 0.4 to 0.5 to inflation. But if we would see this global universal tariff, we're probably coming up well above 10 percentage point in tariff increase. Goldman has a base case of 10 and a risk case of 15. If we are in the Goldman base case scenario, inflation in the US this year could increase up to between 3.5% and 4%. And if we were in the risk case, it could actually go up substantially more. It is very rare that we are in a market situation with this wide outcome space. One should also note that if we get market reaction, it's not unlikely that Trump or Bessent or Lutnick or somebody else comes out and says that there is a deal-making process ongoing and that the outcome will be less problematic. But in the base case, I think we should accept that inflation this year in the US is going to be substantially higher, growth weaker, maybe in the neighborhood of 1.5% to 2%. So the US was in a really good position with strong productivity growth, an investment boom, and good support for the consumers. But we have to realize that if inflation is coming up, this substantial amounts we're talking about, real wages will be soft this year and also soft next year. So US consumption has less of an underpinning. The uncertainty is also very high at the moment, and normally uncertainty hits capex. So there is a risk that the strong capex boom we've seen in the US actually will slow down a bit. So it is a very complicated situation. Obviously, Trump will try to find some negotiations, but you have to note that Mark Carney is now in an election process in Canada, and he will not be re-elected until, or the election result will not come until April 28th. So that complicates the negotiation process with the most important country for the outcome, Canada. In Europe, we are in a bit of the same situation, because Friedrich Merz, the new Bundeskanzler in Germany, is not likely to form a government until late April. So negotiations with the two most important counterparties might not happen until early May, and tariff negotiations are very complicated because there are so many different goods and so many different tariff levels. So there is a risk that these negotiations drag out a bit into May. So it is a fairly long period of negotiations that is coming. Previously, I've had the view that deregulation and tax cut could, to some extent, compensate this. But if we look at the reconciliation process between the House and Senate that is now ongoing, it is fairly unlikely that we get clarity on fiscal policy until at least September. And what has come out so far, I would say, is a medium-sized tax reform, 1.5% of GDP. Let's remember that Reagan did substantially more and that Kennedy did almost twice as much back in the days. So it is not the major tax reform. It might improve a bit on the corporate tax, estate tax, and individual tax. But on the other hand, it will add a bit to the deficit. So I think we also should think about the US deficit at least above 6% or even close to 7% the coming years, which also adds a bit of uncertainty in terms of interest rate trajectory. To sum this up, I don't think this is a time for hitting the crisis button. Oil prices are moving around 74, so we haven't got any energy shock. The financial system is in very good shape, so I can't really see a financial crisis looming. Most economies of the larger size doesn't have large current account deficits that are vulnerable for a currency correction, and most countries today also have floating exchange rates. So if we don't get an oil crisis, a financial crisis, or a currency crisis, I think we are at least in a situation where we don't have to go to fill the sandbags and store cans of food. But US growth might come down from a trajectory of 2 to 2.5 to maybe, let's say, 1 to 2%. So it is potentially very important to follow the news both today and the coming days, because we know that President Trump is the master of the deals. So where this ends, we cannot be certain, but it's pretty clear that the directions are up for inflation and down for growth in the US.
Okay, that's the US and a lot of different moving parts there in the US and everything that you were saying. What's the impact that will have or is having on Europe?
Well, tariffs are a dangerous instrument. Announcements are bad, and retaliation is also bad. So we should also take on board that during April, we're quite likely to get negative stock market reactions from retaliation measures from Canada, Mexico, and Europe. Europe obviously have choices. A rational choice would be to re-engage with trade negotiations with other areas. Europe potentially could join the Asian trade agreement like Canada and the UK have done. We could also make a trade deal with India. That would be positive outcomes. The difficulty here is that trade negotiations are not fixed over a weekend. So this could happen, but it probably will take at least a couple of weeks and months before we get clarity. Europe could also reduce our own regulatory burdens to improve the single market, and that would kind of counter the negative impact from US trade. Potentially, we could also do more self-damage. There are rumors, and we saw an interview in the FT with Ursula, where she stated that we should also take steps against US tech. And given that Europe already is lagging in tech and that we are now in this great AI move, it would obviously be detrimental to European growth if we start self-harm in terms of attacking the US tech companies. We should remember that Europe is a large closed economy. The revenues that are exposed from the company side is fairly small. Services and production in the US are the bulk of the 25% that the Euro Stoxx 600 is earning in the US. However, the EU Commission has also opened up for entering tariffs into the service sector, which is extremely difficult because we don't really know where services are produced. Obvious for software, but also for other services. There could be teams sitting in the US, UK, and spread out over Europe. So where you really produce that service is complex in these days with Teams and Zoom meetings. Hopefully, Northern Europe, in combination with Italy, are able to push back on the Commission so that we're not getting to get over the threshold of starting to do countermeasures on services. I'm slightly hopeful that Europe could tie its hand enough to do a limited amount of self-harm. And the impact of the economy in Europe will obviously be less because our trade exposure to the US is fairly small. We should also note that during the coming weeks we are getting new news on Germany, and I think there is a bit of potential that the new expenditures on defense infrastructure could actually be positive. Germany needs a lot of structural reforms. So far the negotiations haven't made that much progress, but labor market, capital market, investment climate in Germany potentially could improve a bit over the next few weeks. So I'm not that worried about Europe at this stage, but I do think that we should also reduce the probability for a peace agreement in Ukraine at this moment.
Mm-hmm. Okay, there's a lot to think about also then when we're talking about Europe, and then we come to the broader question, I guess, on emerging markets and the diverse economies there. What do you see if we're talking about emerging markets?
Well, I still think we should hold on to a trajectory where Asia is growing between 4 and 5%. China this year could actually come close to 5, and India will grow faster than that. Southeast Asia is in a trajectory where 4 to 5% is the general growth rate. So nominal growth in Asia is strong. Macroeconomic fundamentals are pretty good. There could be an impact from the tariffs, probably least on India. They are less exposed to US trade. They don't have a large trade surplus. The domestic growth is also driven by internal investments and consumption. On the other hand, obviously China could be harmed if Trump is going more heavy on China. Numbers like 60% tariffs have been mentioned. So for China, it would be a relief if this is only a global tariff. China has put itself in a pretty good position to withstand this, given that we now see strong export growth, strong industrial production growth, and we also see a bit of improvements on the real estate crisis with the new packages a couple of weeks ago for supporting domestic consumption. And the deep-seek moment of China has improved the outlook for tech, and also the fact that Xi Jinping, the president, is now giving positive comments on tech. So I think there is a chance that China can actually withstand this. If Trump goes hard on China, the rational answer to this would be to let the RMB depreciate maybe to 70.50, 70.75 or something like that against the dollar, and also do massive QE to push down the 2-year and the 10-year interest rates. If that is the policy response, one should note that lower interest rates actually would then contribute to the healing of the real estate crisis. So a deeper depreciation of the RMB would be a bit of turbulence, would bring a bit of turbulency for emerging markets, and I think we actually will have to follow that and see how it plays out. So it is a complicated situation.
Mm-hmm. You've given us a lot to think about. It's definitely complex, and we know that we have Trump speaking tonight, so we don't know what will come out of that. But you've touched on the US, you've touched on Europe, you've touched on emerging markets. What to do for investors? What does all of this mean for investors?
Yeah, I saw a comment from one of the US fund managers saying that he aggressively is doing nothing. Because it is difficult to assess the situation. We've seen a 10% correction on S&P 500 and a 15% correction on NASDAQ. So obviously valuations are a bit less stretched in the US. The US economy, even with the slower growth, actually has pretty good sales numbers from the companies and also pretty high productivity, which means that profitability and profit margins are pretty well supported. My general view is that you should not trade the markets by jumping in and out because normally it is very difficult to time that. Time in market is much more important than timing market. So I think the best advice for investors is to stick to long-term strategies. Obviously, the fund managers need to work through which companies are more and less exposed, and I would still stick to the view that companies with strong fundamental growth, higher profit margins, a bit of moats around their profitability, and exposure to underlying growth in the regions are preferable. But it is a difficult position we are in, and obviously fund managers need to kind of scan through the portfolio to really see how you can get rid of or get out of companies that are a bit more exposed. So a very complicated situation, and obviously we don't know what is coming late tonight, and we will need to understand also what Trump is saying after his announcement and what Bessent and Lutnick are doing. But it is a complicated situation, and it's fairly rarely that we have this broad outcome space on a single day event.
Thank you very much for all of that, and we'll be watching this evening and see what comes out of that, and hope that you'll join us for an update again soon.
Thank you very much.
you.